There is a house in Florida, right now, sitting in a quiet, utterly ordinary suburban neighborhood that you probably wouldn't look at twice if you drove past it on your way to work. The lawn is neatly cut. The cars are parked in the driveway. There is a basketball hoop in the cul-de-sac and a few bikes resting against the side of the garage. The people living inside this house bought it exactly 8 years ago, during a time when the fundamental math of the American dream still made logical, predictable sense to the working class. They sat down at a closing table, signed a mountain of paperwork, handed over their hard-earned down payment, and locked in a standard, traditional 30-year fixed-rate mortgage. For 8 consecutive years, which is 96 months in a row, they have never missed a single payment. Not one. They didn't take out a predatory, adjustable-rate subprime loan that they couldn't understand. They didn't borrow heavily against their home equity to buy boats, luxury cars, or vacations they didn't need. They didn't suddenly lose their jobs, and they didn't arbitrarily decide to stop paying their bills. They did exactly what the foundational pillars of the American dream. The banks, the brokers, and the conventional wisdom have always told the middle class to do to achieve safety. You buy a modest home, you lock in your interest rate, you budget your income, and you slowly build stability over decades. But tonight, that same family is sitting quietly at their kitchen table, staring at an official, legally binding notice of foreclosure. The psychological weight of a foreclosure notice is cold, but the math is colder. For a family who did nothing wrong, that piece of paper is not just a notice. It is a declaration that the system they invested in has officially stopped working for them. This isn't the 2008 housing crash. This isn't a story about reckless lending or people buying massive mansions on a bartender's salary. This is a story about a family who played entirely by the rules, only to wake up and discover that the rules of the math had quietly and violently changed while they were sleeping. Over the past 12 months, the ground beneath them simply gave way. Their property insurance premium didn't just inch up by a few percentage points to keep pace with standard inflation. It doubled in a single year. Shortly after that shock, their local property taxes jumped following a highly aggressive new county assessment. Then, their monthly utility bills climbed roughly 40% due to rising regional energy costs. But the actual killing blow didn't come from the bills themselves arriving in the mail. It came directly from their mortgage servicer. When your insurance premium doubles, your mortgage servicer doesn't just send you a bill. They raid your escrow account to cover the deficit. Then, they permanently hike your monthly payment to replenish that cushion. You aren't just paying for the insurance. You are paying a penalty for being unable to afford a market you don't control. Suddenly, the $1,800 monthly payment they budgeted for became $2,800. It is escrow shock, and for thousands, it is the final nail in the coffin. They tried to cut back on groceries. They canceled every subscription. They completely depleted their modest emergency savings account, trying to bridge the widening gap. But you cannot simply out-budget a sudden, permanent $1,000 increase to your baseline survival cost when your paycheck hasn't moved an inch in 3 years. They simply couldn't keep up with all of it converging at once. Now, the cold, mechanical legal machinery of foreclosure has officially started. The bank isn't taking their home because they are financially irresponsible, careless, or because they made a bad economic bet. The bank is taking it because the basic, everyday holding costs of simply maintaining the American dream have become mathematically impossible for a normal working family to sustain. And if you think this is just one isolated, unlucky family living in a high-risk state making a localized mistake, you are entirely missing the terrifying scale of what is actually happening in the shadows of the current economy. You need to look away from the record-breaking stock market completely and see what is actually happening to the raw data on the ground across the entire country. In the first quarter of 2026, the data finally caught up to the harsh reality that ordinary people have been quietly feeling for months. According to Atom Data Solutions, which is one of the most authoritative and widely respected sources on national property data, there were a staggering 118,727 foreclosure filings in the United States in just the first 3 months of the year. That is a massive 26% spike compared to the exact same time last year. It is the absolute highest level of foreclosure activity we have seen since the economic chaos of 2020. That number is not a glitch in the reporting. It is not an anomaly that will correct itself next quarter. It is a blaring, unavoidable siren indicating that the financial buffers of the American middle class have entirely evaporated under the weight of compounded inflation. But a filing is technically just the beginning of the legal process. It is just a piece of paper filed at a local courthouse by a lender signaling the beginning of the end. Filings can sometimes be cured, delayed, or fought in court if the homeowner can miraculously find thousands of dollars to catch up. The number that should actually make you stop whatever you are doing, put down your phone, and pay immediate attention is the number of families who have run completely out of time and options. 14,020. That is the exact number of actual, completed bank repossessions that took place in just the first quarter of 2026. That represents a terrifying 45% surge from the previous year. You have to force yourself to picture what that number actually looks like in the real physical world outside of a spreadsheet. That is over 14,000 families physically forced out of their properties in 90 days. That means thousands of moving trucks pulling up to houses in the middle of the night so people can leave without their neighbors seeing. It means sheriff's deputies knocking on doors to change the locks on a Tuesday morning. It means children being suddenly pulled out of their local school districts in the middle of a semester because they have to move into a motel or a relative's basement 3 towns over. It means entire lives, memory, and decades of hard work completely packed into cardboard boxes and moved out to the curb. This isn't a slow, creeping, theoretical economic trend that academics are casually debating in university halls. It is a sudden, sharp, violent acceleration of wealth destruction. And the most terrifying part is that it is hitting people who genuinely believed they were perfectly safe. They thought that because they were paying their principal and interest perfectly on time, the system would fundamentally protect them from losing their shelter. They were wrong. The banking system doesn't care about your principal and interest if your escrow account falls into the red. It doesn't care about your perfect 8-year payment history. It only calculates the current deficit. When the carrying costs of the home explode beyond your capacity to pay, the equity you built is stripped away, and you become just another statistic in a quiet crisis that nobody on the evening news is warning you about. The absolute epicenter of this quiet crisis, the specific place where this brutal financial dynamic is playing out with the most devastating speed and visibility, is Florida. Right now, Florida is sitting firmly in the top 3 states for foreclosure rates nationwide, and the numbers are accelerating every single month. But the reason Florida is failing so visibly is fundamentally misunderstood by almost everyone outside of the state. It is not because of a sudden wave of localized unemployment or a collapse in the regional job market. People in Florida have jobs. They are working hard. The massive wave of foreclosures is a direct, undeniable result of a completely collapsing property insurance market that is effectively acting as a backdoor eviction mechanism for the middle class. Over the last few years, the Florida insurance market has been systematically hollowed out by a toxic, unregulated combination of massive roofing scams, endless aggressive litigation, severe natural disasters, and global reinsurance companies dramatically raising their rates or simply abandoning the state altogether because the risk models no longer make sense to them. As a direct result of this structural collapse, standard property insurance premiums for ordinary homeowners have doubled, tripled, and in some highly exposed coastal areas, quadrupled in just 2 to 3 years. When your property insurance suddenly doubles, that cost doesn't just sit on a piece of paper as a mild warning or an optional bill you can negotiate later. Your mortgage agreement, the ironclad contract you signed with the bank when you bought the house, legally requires you to maintain active, comprehensive insurance coverage at all times to protect the bank's underlying collateral. If you don't pay the premium, or if your private insurer suddenly drops you and you can't find a replacement policy on the open market, the lender is exposed to risk. So, the mortgage servicer simply buys an incredibly expensive policy on your behalf, known as forced-placed insurance, and aggressively adjusts your monthly mortgage bill to recover that massive cost. Even if you secure your own policy at the new doubled rate, the servicer pays it out of your escrow account, driving that account into a massive negative balance. Emotional people. The servicer then recalculates your monthly payment to recover the severe shortfall over the next 12 months, while simultaneously increasing your baseline payment to account for the new, permanently higher premium going forward. This creates a deeply destructive financial phenomenon known as escrow shock, and it is absolutely fatal to a standard household budget. You can have a pristine, incredibly low 3% fixed interest rate that you cleverly locked in during the pandemic refinancing boom, and it absolutely does not matter. Your monthly housing expense still skyrockets completely out of your control. You can pay your actual mortgage loan down to the exact penny. You can be years ahead of schedule on your principal balance. But if you cannot afford the artificially inflated insurance premium dictated by a totally broken and dysfunctional market, the bank has the absolute legal right to take the house anyway. People are literally being evicted from their own homes by the sheer, overwhelming cost of protecting them. It is a tragic, inescapable irony that the very insurance mechanism designed to legally secure the home against a disaster is the exact financial weapon currently being used to force ordinary families out of it. And while families in Florida are slowly drowning in an ocean of unregulated insurance costs, there is another specific demographic that is being completely wiped out by something even more insidious and deliberate. This is a demographic that was explicitly promised protection from exactly this kind of sudden financial shock. We are talking about United States veterans. What is happening to them right now in the housing market is a profound structural betrayal that should make absolutely everyone watching this extremely uncomfortable, regardless of where you happen to fall on the political spectrum. For years, there was a highly effective government program in place called the Veterans Affairs Servicing Purchase Program, which was widely known in the mortgage industry simply as VASP. This program acted as a crucial, functioning, and reliable lifeline for veterans who found themselves facing severe financial hardship. If a veteran fell behind on their mortgage due to a sudden medical emergency, a transition out of the military, a job loss, or crushing inflation, VASP was specifically designed to step in and stop the bleeding. VASP was the lifeline that kept veterans in their homes. It honored the contract between those who served and the nation they defended. But in May 2025, that contract was shredded, quietly, invisibly, and under the guise of fiscal consolidation. That vital program was quietly, almost invisibly, phased out and completely eliminated in May of 2025 under the guise of fiscal consolidation. It wasn't a major front-page headline on any national newspaper. It wasn't debated extensively on evening cable news panels. Most ordinary people, and tragically even many veterans themselves, never even noticed it had happened until it was far too late to do anything about it. But the consequence on the ground for real families was immediate, measurable, and exceptionally brutal. Because that specific safety net was quietly pulled out from under them, more than 10,000 veterans have lost their homes to foreclosure since last May. Let that number sink in. 10,000 families. These are people who served their country in active combat zones, people who returned home with permanent physical disabilities or severe PTSD, trying to reintegrate into civilian life, people who were explicitly guaranteed a VA safety net as a core part of their service agreement. When the broader economy turned hostile, when massive inflation ate away their fixed purchasing power, and when the math of daily survival stopped working for them, they reached out for the ripcord they were promised was always there. They pulled it, and they found out in the most terrifying way possible that the government had already cut the lines. They were left in a total financial freefall, entirely at the mercy of private loan servicers whose only legal and moral obligation is generating profit for their shareholders. To see 10,000 veterans forced into the street, simply because a bureaucratic assistance program was quietly sunsetted to save money, is a profound failure of national priorities. It proves that the systems designed to protect the most vulnerable can disappear overnight without anyone saying a word. But the nightmare certainly doesn't stop with the veterans. The broader national safety net that is theoretically supposed to exist for everyone else, For the working families, the single mothers, and the elderly living on fixed incomes is essentially just a massive bureaucratic illusion at this point. If you fall behind on your mortgage right now and frantically search the internet for government help, you will inevitably be pointed by official websites and state housing counselors towards something called the Homeowner Assistance Fund, or HAF. On paper and in press briefings, it sounds like a massive, impenetrable financial backstop. It was established as a nearly $10 billion, specifically $9.96 billion, federal fund designed exclusively to provide direct financial assistance to struggling families to keep them in their homes during times of extreme economic distress. It was supposed to cover mortgage arrears, utility defaults, and those soaring insurance costs we talked about earlier. If you read the official government press releases, the official federal expiration date for that massive program isn't until September of 2026. That specific date gives desperate, terrified families a completely false sense of hope. They look at the calendar and they think they have time to figure this out. But the reality on the ground, in the actual trenches where people are desperately fighting every day to keep a roof over their children's heads, is a completely different story entirely. As of May 2026, multiple states across the country have completely and entirely drained their financial allocations from the half-AF program. The money isn't just running dangerously low, it is simply mathematically gone. The state-level application portals where families are supposed to upload their sensitive financial documents have been permanently shut down and quietly replaced with sterile, unhelpful error messages telling them the program is closed. Yet, families are still receiving terrifying foreclosure notices in the mail every single day. They are still calling official state hotlines in a panic and being told by well-meaning but totally disconnected housing counselors to apply for this exact federal help. These desperate homeowners spend weeks frantically gathering years of tax returns, bank statements, pay stubs, and emotionally exhausting hardship letters. They navigate a complex, soul-crushing bureaucratic maze, waiting on hold for hours at a time, skipping work shifts to handle the paperwork, only to finally reach the very end of the grueling process and find a locked door and an empty bank account. The help exists perfectly on official government paper. It exists in the confident speeches of politicians claiming they are actively supporting the middle class. But it absolutely does not exist in the reality of the people who actually need it right now to stop a county sheriff from evicting them next Tuesday. It is an incredibly cruel illusion of a safety net, designed to make society feel better about itself while doing absolutely nothing to stop the bleeding on the ground. Giving people hope when the vault is empty is not just bureaucratic incompetence. It is a betrayal of the one thing they had left: time. When you finally pull all of these separate, ugly threads together and look at the entire picture from above, what you are looking at is not a series of individual financial mistakes or personal failures. The exploding insurance markets in Florida, the quiet abandonment of the veterans, the phantom $10 billion assistance funds that ran completely dry months before their expiration date. These are not isolated incidents. This is not a story about thousands of people suddenly forgetting how to balance a checkbook or irresponsibly buying too much house. It is a highly coordinated, systemic, structural eviction of the working and middle class from the institution of homeownership. For generations, owning a home was the single most reliable, fundamental mechanism for an American family to build generational wealth, stabilize their living costs, and secure their permanent place in the broader economy. Now, that exact mechanism is being methodically dismantled from the inside out by rising holding costs, exploding unregulated insurance premiums, and silently disappearing federal safety nets. When the basic, non-negotiable cost to simply keep what you already legally own drastically outpaces what a normal full-time job pays, the system is fundamentally broken at its very foundation. We are watching in real time as families who played by every single rule, who did exactly what society asked of them for years, get completely wiped out by systemic, structural costs that they absolutely cannot control, cannot predict, and cannot escape. And waiting quietly in the background, fully aware of this exact dynamic, are massive institutional investors and Wall Street private equity firms. They are sitting on billions of dollars in dry powder, eagerly waiting for these foreclosures to process so they can buy up these distressed homes at a massive discount, slap a fresh coat of paint on them, and rent them right back to the very families who just lost them. It is a massive, incredibly quiet transfer of wealth and property from the middle class to the top, perfectly facilitated by a financial architecture that prioritizes escrow accounts and corporate risk models over human stability and community survival. This isn't just about the families losing their keys in Florida or the veterans left behind by a sunsetted program. It is about the quiet evaporation of the American middle class. When the mechanism for building generational wealth becomes a tool for institutional extraction, we have to stop asking if this is a series of mistakes and start asking if it is the new design. We are witnessing the end of the American homeowner as a stable, viable class of citizen. We aren't being forced out by a market crash. We are being priced out by a system that has decided we are no longer a priority. What about this reality makes you the most angry? Drop it in the comments below.